All right, I think we have just about everyone. So good afternoon, everyone. For those of you who I've not had the pleasure of meeting, I am Salco Savara, and I am president of CORA Capital Advisors. And with us today is Sam Flamma from Lincoln Financial Distributors, who will be our guest speaker. I want to thank you for joining us, and especially as this is our inaugural CORA College webinar. And our goal is to present a topic a month, and we are certainly looking forward to bringing all different aspects of the financial planning spectrum to you and hopefully educating you as best we possibly can. Now, normally it would not be like us at CORA to actually have discussions with clients about a specific product or an idea until after we have gone through our financial planning process and really worked to understand the situation. However, today we thought that we would have Sam speak because the product, the solution that he represents at Lincoln is very unique and it's very timely. We've had, as a group, a large number of clients express to us how they are concerned with the stock market and volatility and let's say, losing a lot of their capital. And while there is no perfect solution, we feel as though there are products out there that can help achieve your goals and get you from point A to point B in a desired fashion. It may not be the perfect solution, but nonetheless, a solution that provides you opportunities for growth and protection at the same time. When Sam goes through what he's going to, I would certainly ask that if you have questions that you let us know. The Q&A is available via chat and texting. And then if you have additional questions afterwards, I would ask that you please reach out to your advisor at CORA Capital, or certainly reach out to me. And we're more than happy to follow up and answer any questions that you may have. And with that, I'm going to turn it over to my friend Sam Flamma for today's presentation. Sam?
Thank you, Sal. I think I'm going to share this screen because I want to show everybody what's going on. But before that, I'm honored to be the first guest of what is a brand new process. That's exciting. I think it's a great idea. And I'll tell you what, obviously good timing here, right? I mean, there's nothing boring about markets and the economy and banks and everything else right now. So I think the more we do this, and the more we kind of educate your client base, the better off everybody's going to be. So
thank you.
I mean, like you said, it certainly is a product, but I think the way I'm going to present it is more of a concept or a solution, or there's a lot of different adjectives I guess we can use to say just something that's going to help where you currently sit right now. So I'm going to make two assumptions on who is on this call. I guess all of our fifth grade teachers always told us never to do the assume, and they kind of spelled out why you're not supposed to and all that stuff, and everybody giggled. But I'm going to do it anyway, even though Mrs. Price would not like me to do this. So I'm going to make these two assumptions. I'm going to assume that we have either clients that are on this call that are more interested right now in fixed instruments. I mean, there's a lot of buzz around bank CDs. I mean, it's funny when you talk to the banks. There's a lot of banks that are saying we don't need any more capital because the CD is much more appealing now than it's been for a long period of time. So I'm going to show you an alternative to that, or something that could probably help that story out if we have CD investors that are out there. And then the second assumption I'm going to make is I'm going to make an assumption that many of the people that are on this call also have equity, right? You have money in the stock market. And what's great about this product is it addresses both of them, but just in a little different way. Now, Sam, can you see this Lincoln Level Advantage sheet that I have on the screen?
Yes, I can.
Let me ask you this: if I just kind of make a circle around an area with my cursor, are you able to see that as well?
Yes.
Great. All right. So there's a lot of numbers on this page. Don't get intimidated by it. We're gonna make it real simple. So we're gonna kind of camp out right here. See this 30% protection, 110. All right, that's the one I want to concentrate on for people that either own CDs or the CDs coming due. When I say CDs, it's also short-term government bonds, fixed annuities, and anything that has that yield where you can't lose money. So they're already. I'm just going to call them CDs all the way through, but everything that's in that CD family certainly pertains to what we're going to be talking about. So this 30% protection with the 110 is what we'll discuss. And then when we're done with that, we're going to hop over just to the left here. See this 20% protection with the 500. And just to put it in nice, neat, easy categories, right? The 30% is going to be that CD client, and the 20% is going to be for people that already own the actual stock market, right? So here's how it works. So we won't spend too much time on it because again, pretty simple concept. This is right here. If you start back all the way to the left-hand side, it sees here's what you're going to be invested in. It's the S&P 500. And it's the exact S&P 500 that you see if you're looking at the quotes on CNBC, or if you just simply see it at the 6 o'clock news or right before dinner. It's the exact S&P 500 that we know. And what we're going to do is we're going to own it for 6 years. So it's the S&P 500 for 6 years. But here's the little twist that we bring to the table with Lincoln. What we will do, and let's start over here with the 30% protection. What we say is you're going to be invested in the S&P 500. But over a 6-year time period, the first 30% of losses will not be your problem. Lincoln's going to handle that. So if 6 years from now, the market is down 25% and we put $1 million in that contract, even though the market was down 25%, you will get your $1 million back to the penny 6 years from now. Right? So obviously that's a nice way to own the S&P 500. It's a nice way to own the stock market. Now, I like this 30% protection with a very conservative client. And here's where I'll talk about the CD for a second, and then we'll go back to the product and talk about exactly how it works. So CDs, like we said before, there's a lot of people that are buying CDs. Banks are getting flooded with assets for CDs, and it makes sense for it. It makes sense for the reason why. Right? If I go back before last year, I go back prior to 2022, for about a 7-year stretch, it was very difficult to find any yield, right? You were lucky to find it. If you found a CD that was at 2%, and people were flocking to get that, because there was times where a CD was only 1%. There was times where a CD was 0.5%. But let's just look at 2%. Let's just say back when we were getting 2%, I heard this all the time. Sal, you did as well, I'm sure. Clients were saying, I wish we could just get back to the good old days where I could get a 4.5% or maybe a 5% CD or a bond, and that would be just a spectacular spot to be. And that's why we were getting the 2%. Well, I probably don't have to tell many people on this call, but if 4.5 or 5 is what you are hoping for, your wish has been granted, right? You can find 4.5% CDs, you can find 5% CDs right now. But we got to look into it a little deeper. Right? Because I always like to break it down. When we were getting a 2% CD, let's throw another little thing in the equation. It's something that is near and dear to everybody's heart. It's probably a little bit of a pain right now. It's a pain for me and my family, and it's that word inflation. Right? Yep. Right. So when we were able to deliver a 2% yield, inflation was probably at 1 or 1.5%. So while that was going on, while we weren't dazzled by how much we were making with the 2%, we were at least fighting inflation, and we were getting a little extra out of the story, right? If I have a 2% yield and a 1.5% inflation, I was making money at the clip of 0.5%. Now that we're getting 4.5 to 5, let's call it 4.5, that feels really good. But inflation's at 6.5%. Right? So if I do that net number, and a lot of people, the government reports inflation's at 6.5%. I wish I could see a show of hands. I think most people would raise their hand if I said, do you feel like this inflation's a little higher than 6.5%?
Not even close.
In the real world, we would sign up for 6.5 right now. But let's just use those conservative numbers that the government is telling us. Obviously, and this is not an for folks. I mean, if we're getting 4.5%, and inflation's at 6.5%, our net numbers are -2. Right? And that doesn't mean CDs are horrible. Never talk to them. That doesn't mean that short-term bond funds are not something that we should implement in our product. But there's a lot of people, when you do that math, they realize that -2 is an issue. I remember having this conversation with Sal, and he shared with me, because that's my biggest challenge. There's a lot of people are going to sign up for 5-year instruments that are giving them 4.5%, and at the end of 5 years, they're probably not going to be happy with the growth compared to what they can buy. Well, I said that's my sentiment exactly. I said what would make sense under that environment is, as your financial advisor, which I am not, I'm just a product specialist. Sal and the folks at CORA Capital are your advisors. I think what we're all looking at is saying we need to offer another option. If somebody wants to buy a CD, or you own a CD and you're looking to buy another CD, that might be fine, but we really need to, when the number shows to be a -2% net number, we have to show you another option. You don't actually have to do it, but we have to show you another option. And now back to our product, because what's nice about this is, if we are a CD investor, I would say, kind of 3 things. Number one, congratulations, right? The market is down considerably for the past, we're at 13, 14 months right now.
Yep.
Not a lot. Bonds are down a lot. If you have that traditional 60-40, we probably had one of our worst years ever. Right. So if you're not in the market, if you're not in the bond market, and you're sitting in a CD, first thing I want to say to you is congratulations. A lot of people are down, and you are not, at least in that portion of your assets. The second thing I want to talk about, though, is now you have a really nice opportunity. Right? When stock markets are down, and they're down, let's just call it 20% from its very top. Is that fair, Sal?
Yep, I would agree.
So we're down 20%. And we can use any one of the little jargon cliches that we use in this business, right? Anybody ever hear of buy low, sell high? When the market's down 20%, that's obviously low. That's traditionally a nice spot to get in. Doesn't mean it can't continue to go lower, but over time, when I buy something that's a 20% discount, that's typically a nice thing. And it's funny, most people don't want to buy equities when markets are down. But every other purchase that we make, when it's on sale by 20%, we sprint to that thing, right? We like buying all other consumer related products when they're 20% on sale. Well, the S&P is that, right? Which means, again, it has a very good opportunity. The only problem is, if you're a CD investor, even though the S&P is a great opportunity because we're 20% on sale from what it was just about a year ago, it's very difficult for the folks at CORA and Sal to put you into the stock market, right? Because your risk tolerance isn't there for it. Would you agree with that, Sal?
I would absolutely agree with that, Sam.
So that's kind of the dilemma right now, right? It's great that we didn't lose money in our cash and CDs, and now we have a great opportunity. But when we look at it, we really can't deliver it to you unless we can give you the S&P. Now we'll go back to the screen that we talked about. Unless we can give you the S&P with a 30% protection, which I'll tell you this, folks, that is the most conservative way to own the S&P 500, literally in our industry. Think about it. The market's already down 20%. So it started here, it's down 20%. The next 30% of losses, if they occur, that's Lincoln's problem. That's not yours, right? So when we talk about an extremely conservative way to jump into a great opportunity, which is the stock market off of this discount from a year ago, that's where we are getting a flood of assets on that super conservative type of client with a 30% protection.
Okay.
2 other things to talk about. Because when I give you that type of protection, something's got to give, right? And the thing that gives here is, you see this 110? That in our industry, we call that a cap. So here's what it means. If I put that $1 million into this product, we know that the next 300,000 of losses, if they occur, I'm not going to have to deal with it. Let me add one thing to that. If we're down 31%, which, by the way, I'm going to show you something in a second that shows that that's never happened, which is a nice story. If we're down 31%, you will get one, right? We'll take care of the first 30. But back to the 110, that shows you just how high your account value can go. So it has what we call a cap, meaning it only allow you to go so far. Right? So if it was a 100 cap, which is a little bit better, that means the best you can do in a 6-year time period is a double. So $1 million in this scenario can go to $2.1 million. And that would be obviously a fantastic market. Most people say that I don't think there's an analyst on the street, whether you're talking about Goldman Sachs or Morgan Stanley, nobody's expecting this market to double in the next 6 years. So that's where I think this is very attractive. And I'll tell you the reason why we probably didn't talk to you much about this a year ago is because the caps were extremely low at that point. So you probably remember when the cap on this was 40.
I do remember, which is why we were not even bringing it to the attention of clients.
All right. So at that time it was 40. This product is very, very sensitive to interest rates. That's very sensitive to volatility. In other words, when interest rates are high, which is certainly the trend that we've seen over the last year to 15 months, when interest rates go up, that's bad for a lot of things. Right? That's bad for stock markets. We saw that, right? That's not great for real estate. That's not great for the economy, but it's really good for insurance products. So here's all the time. How do I leverage this? Interest rates are going up. How do I take advantage of interest rates going up? Well, one of the things is a product like this, because again, the cap a year ago was at 40, meaning the $1 million can only grow to 1.4 million. Folks, I wouldn't call that the S&P 500. The S&P 500 over 6-year time periods it's got a history of doing a lot more than that sometimes. When I get into the scenario where we can do more than a double with that 30% protection, and the last thing that I'll add is this has absolutely no fee. Right? So all I'm here to do is I'm the product, I would be considered your product specialist. Right? You need to sit down with the folks at whether it's Sal or any of the financial advisors at CORA Capital, sit down with them and determine whether this makes sense for you. But those are the 3 bullets I want you to think about. 1, excellent protection. Second thing is your upside is not what it was a year ago. The upside giving you the ability to do more than a double, to go 110% to a cap to the upside is a very attractive upside. And back to inflation, the stock market has always been that story of how can I best fight inflation? Historically, what asset class has done the best to fight inflation? And I think, and Sal, correct me if you think I'm wrong there, but equities have always been the best story for that.
Yes, they have.
So I'm not going to spend as much time on this 20% protection with the 500 because it's a pretty simple concept, right? It's just a little less protection. Right? I have a 20% protection versus the 30. But think about this: if you're already in the stock market, let's say you own a mutual fund. My question is, if the mutual fund called you tomorrow and said, right now you have no protection, which you don't. And I own mutual funds, Sal owns mutual funds, and none of them have any protection. But if the mutual fund came to you tomorrow and said, would you like us to put a 20% protection on? I guess the question you got to ask yourself is, what would you say? Would you say yes, that makes sense, or would you say no? I think most people would say yes. And the nice thing is your fee goes to 0 with the 20% protection. And what's really nice right now, and the reason why I like the story of this 500 is, that's the cap. The cap is 500, which if you look at, go back in history, the greatest 6-year time period that we've ever seen was up 236%. Sal has that information. He could send that out to you if you like to look at it. So we'll have a cap now that's at 500. And again, I'll also show you the past history. And history was, if we were doing this a year ago, the cap was at 60. Another reason why I wasn't invited in on this type of an event, because that is not looked at as the stock market. When you have something that's a 500 cap and I compare it to a mutual fund or any other investment, there's not an investment out there that has a cap. When you have a 500 cap, that fits into that category of not having a cap and just making it a heck of a lot more conservative with a 20% protection. At the end, I'm sure Sal will talk about this a little bit. Whether we're talking about somebody that's already in equities, I really believe that 20% protection with a cap that is ridiculously high, and it would be a shock to everybody if it ever hit that cap. That's where the equity portion would make sense with that very nice 20% protection. And if we're really conservative looking at CDs, that extra protection of 30%, potentially giving up something to the upside. You know, markets have had times where they're more than 110. That's where I think if this is now implemented into the portfolio, the thing that I love about this is if you just look at your current portfolio, if this is implemented for even a little bit, it just makes the portfolio better.
Hey, Sam, the one thing that we always look at when we are making recommendations to clients is that everything has, I like to say, an upside and a downside, a good side and a bad side. There's always a catch, yep, so to speak. What would you say the downside is of this particular product?
Yeah, great question. And I would say there's two of them. There's two things that I would consider a downside. One of them is the S&P 500 normally delivers you a dividend, right? And a dividend, whether people are on this call, if you buy a stock, a really stable company usually has a nice dividend. So you're hoping for that price appreciation, right? If the price of the stock's at 50, we want it to go to 55. But the dividend says no matter what it does, you're going to get a payment on this. This particular product does not have a dividend, so you do lose that when it comes to the S&P 500.
Okay.
The last I looked, and please don't quote me on this, but I think we're probably about a 1.6% dividend is on the S&P 500.
Yes, I know it's right around there. It's an ever moving number.
Certainly is. So,
yeah.
Well, I think the one thing you may want to, the best way to look at that is because, as I mentioned before, this comes to you at no fee. And it really is. There's no fee for the investment. There's no fee for the setup. There's no fee for the advisor. There's zero fee to this whatsoever. So a lot of people look at that and say, all right, I lose the dividend, but I also grab this thing in a no fee. And if the fees, for the most part, fees usually take up most of that 1.6 dividend. So if we look at it that way, it kind of levels the playing field, right? If I get a dividend with a fee, is probably very close to a no dividend with no fee. So now it really makes this story a little bit easier because it really just says, look, one has a 20% protection and the other one does not.
Okay.
So that's the one give back. The second one I think is something that you got to look at a little closer, right? So you do need to be in this product for 6 years. There's a 6-year surrender. So typically, when I sit down with advisors like Sal and the client, we don't have to spend much time on whether they like this story or not. I mean, everybody loves a story where I can be really conservative and get all of the upside. I think most of your time is spent on kind of a liquidity needs analysis, if that makes sense.
Yeah.
Right? That's not something that I'm here to do today, but again, as we mentioned in the beginning, when you sit down with the folks at CORA Capital, if we find out how much you need in liquidity, if there's a balance there, and you're really going to have a hard time making a case to not use this type of strategy because it is very effective.
Okay. One question that came up is after 6 years, what happens? So you've said that there's a 6-year surrender charge. So essentially what that means is that clients that are acquiring this product are going to be in it for 6 years. And I would say to anyone that when purchasing a longer term investment, such as an annuity, if there's not a commitment for a time period, at least 6 years plus, we should certainly look elsewhere. But after that 6-year period, what happens? What are the client's options?
You got one of three things that you can do. The first one, and this is where I'll even drive home the no fee story. Let's say the market doubles, right? We start today and it doubles. No one's calling for that.
That would be fantastic. I'll take it if somebody knows.
I think everybody would.
Call somebody and make that work, Sal. I'd be very happy with it. But let's say it doubles, and if I put $100,000 in, that means it's worth 200,000. So one of your options is we'll cut you a check for the $200,000. It'll be to the penny, right? It's not 200,000 minus a ticket charge or minus shipping and handling or anything of that nature. We can cut you a check for the 200,000.
Okay.
Option two, if you say, okay, I want to stay invested. I like this idea. Then we can do another 6-year term. You even see some other things there are some 1-year terms that are out there. And again, when you sit down with Sal, we can go over this. There's some 3-year terms that are out there. So under 6 years, you have some other options that are out there. My favorite is the 6-year. So you can do another 6-year.
And at that point, it's nice because you're completely out of, there's no surrender penalties. You're completely liquid in that second 6-year version. If you're 5 months into it and you say, I want the money back, you can have the money, right? So that's the second thing you can do. You can kind of do another term, is for lack of a better phrase. And the last thing that you could do is with all annuities, you could do what's called 1035 exchange. A lot of people buy it that way because this is an annuity that's just there to kind of protect the account value. There's other annuities that can protect your income. So let's say 6 years from now, we're more interested in having an income for life story. Well, this product doesn't do that. But you can do, the IRS allows you to move from one annuity to the next. It's called a 1035 exchange. You can move from one annuity to the next. There's no taxation. And then if you want to go in and tackle something different, like an income need, you can make that move over there. So 3 things that you can do. We'll cut you a check. We will allow you to do a new term inside the same contract. Or the third one is you can do a 1035.
Okay. Thank you.
What else? Any questions coming our way?
So no questions at this point. The one aspect that we've discussed about this is the type of account that this may be geared towards. So is it a client that has taxable money, a client that has retirement money? Where do you see this fitting best?
So I think the nice thing about this, annuities, the old form of an annuity was usually used for somebody that was getting a little bit older, closer to retirement, or already in retirement. What's nice about this product is I'm 50 years old. I actually own 2 of these contracts that are here. But I will tell you, I do only own it in my qualified money. I own it in my IRAs, right? Because let's go back to that. I said there was 2 things you got to watch out for on this product. One is liquidity. As a 50-year-old, I can't touch this till 59 and a half anyway. So my qualified IRA money, I have no liquidity anyway. So I just completely eliminated that. So there are a lot of people that like to put their IRA/qualified money into this contract.
Okay.
Somebody that is 59 and a half or older, now you don't have that second liquidity issue that some do. So if you have that we call non-qualified money, right? Money that's not in an IRA or 401k or 403b, it's just kind of savings that are out there. I think we just kind of go back to that. What do we need as liquidity? And if I have $1 million in non-qualified money and I need liquidity for 500,000, I would consider this for 5 or 4 or 3 or 2 or 1 or somewhere.
Okay. And I know we've talked about this as well. For clients that may be of the age where they have to take required distributions, this is probably not where you would want to put that portion of your money. You would rather want this to be the longer term money that you might tap later on in retirement, if that were the case. Would you agree?
Completely. I mean, there's a lot of different annuity products out there. Really, 2 of the most popular is the one you're looking at right now. And then there's a more of a traditional annuity that gives you income for life. I think when we're 73 years old in a qualified account and forced into distribution,
I think that there's more traditional products might make a little more sense than this. So we don't see a lot of 73-year-old qualified money coming into this contract.
Okay. Just checking here. It doesn't seem as though we have any additional questions at this time. If anyone has questions, if you would like to type them out and send them along, I'll read them and we'll get them answered. I apologize for not allowing for open mics and video, but due to compliance issues, we have to keep a cap on who is allowed to speak, and there it is. So
just now, while we're waiting for this, let me share one other thing.
I think I mentioned that we can send this out to each client. So while we're waiting for maybe another question or two to come in, I want to take your attention to this area again. Hopefully you can see my cursor again. I'm at that maroon section that says S&P 500 index all the way to the left-hand side. So here's what we did just to show you how powerful that protection level is, right? We looked at the S&P 500 and we wanted to take a look at it over a 50-year time period, right? So we went back to 1970, 71 to the present. Probably could do a little update of this thing. I don't think it would change it much, but there's a 50-year look at the S&P 500. And then what we said is, because our product works in 6-year increments, let's do as many studies of the S&P over 6-year time periods, right? So in our industry, we call that, let's look at it over 6-year monthly rolling. What that means, if I go back to December of 1971, 6 years later, there's a 6-year time period that we can look at. But if I go up 1 month, that could be a very different looking 6-year time period. And every month that I come through, all the way through those 50-year time periods, now we can look at a big sample size of 6-year studies.
It's big. It's, in fact, when I say it's big, there's 529 different 6-year time periods that we can look at. And there's a lot of
the data on here, but I want to kind of cut to the chase. Right down here in this maroon shaded area, it says, okay, there's 529 different 6-year time periods. I want to know details on 2 of them out of the 529. I want to know what was the best
time period that the stock market has seen in that 6-year increment, and what was the worst one in the 6-year increment. So this
does that math for you, right? So it'll even give you the date. So you see this 11/30/1978. That was the ending time period, meaning November 30th, 1972 to 1978. That 6-year time period, that was the worst one that we've seen, and it was down 18.8%.
That's because the market knew I was turning 10 then.
I don't know. There goes your communion money. So let's look at the best one that we've ever seen, right? So this is now going to be March of 1994 to March of 2000, right? 94 to 2000 is another 6-year time period. And that was the greatest one that we've seen, and you're up 36%. Right. So there's a lot of good data here, and this is we could share this with clients. There's a lot of good data here. But when we look at those two, and for some reason I can't go back to the other slide, but let's go back and just take our memories back, right? We have a product that says we have a 20% protection with a 500 cap. Now that might have sounded good when we first looked at it, but I think once we looked at this study, it probably looks even better, right? If I give you a 20% protection and the worst 6-year time period we've ever seen is down 18.8, that means even in the worst environment, you wouldn't have lost a penny. And the best environment that we see is up 236%. Remember, our cap is at 500. So our cap is essentially double the best environment that we've ever seen. So in great environments, historically speaking, at least, you wouldn't have lost a penny of opportunity to the upside.
And so a question came up insofar as the 6-year surrender period. So if someone needed to tap into the contract prior to the end of the 6th year, how would that work?
Glad you brought that up, because I probably go overboard when I say it doesn't have liquidity. It does, right? Every year you can pull 10% of the account out without any penalty at all, right? So if we put $1 million in, that's going to be $100,000 that you can take out every single year without a penalty. So it does have liquidity. And to be honest with you, if you ever call and you say, I just need all of my money, there'll be a back end charge for you to get your money back if you needed all of it. But at least that first 10% is going to be free of charge.
And that's not cumulative. So it's each year individually, you can take up to 10%. But if you don't take it in year one, you don't get 20% in year two or 30% in year three.
No, you do not. But the nice thing is, though, if we put $1 million in, you can always take 100,000 out, even if the account value drops, right? If the account value drops down to 900,000, you can still take the 100,000 out of the account. But the nice thing is, if it grows to 1.1, then you can take 10% of the 1.1. So whichever one is better.
Wonderful. And I would say for those that are listening, as we implement strategies like this for clients, we are mindful that there may in fact arise a situation may arise where you might have to tap into funds that you didn't otherwise think you would. So it's not very likely. Matter of fact, I can probably say this with certainty. It is not likely that you will ever have all of your eggs in one basket. And usually what we will do is reserve this type of solution for a portion of your portfolio. And in this particular product, the way we would structure this would usually be for money that we weren't counting on being utilized within the next 6 years. So longer term money would really be what goes into something like this. And there's probably another point to this too, which Sam, you really didn't touch on, is you have varying degrees of risk that you can take inside of these contracts. So while Sam is highlighting the S&P 500, you certainly have noticed that there are other types of investments that are available. And you can actually mix and match your investments. You don't have to buy them so that you're just investing in just one category. You can invest in different categories for different time periods, and the product can be managed accordingly. Sam, do you want to speak to that for a second?
Yeah, I mean, it's a great point. I was trying to keep it pretty simple, but as you see, there are more options that are out here. So you see this capital strength index. It's kind of the opposite of the S&P 500. The S&P 500 is just a passive index. This capital strength is actual money manager. And many of you probably have a combination of the two. You probably have some indexes in your portfolio, and you have some professional managers that are buying stocks and selling stocks as we go. So that's the nice little combination of the two. So you can have a passive manager with an active manager, which is that capital strength. This First Trust American Leadership, that is purely a technology play. So if you want to have, based on wherever your risk tolerance is, if you want to have 10% in technology, we can build this to look like a full diversified portfolio, probably like what you have right now in mutual funds and ETFs. And this Russell 2000, if you want small cap exposure, it's there. The nice thing is these numbers, where you see all of them are at a 500 cap. So they're all at a cap that you should not have to worry about. Historically, you've never had to worry about anything like that. So to Sal's point, you can absolutely use this. Some people just say, I want this to be my large cap portion of the portfolio. And some people just take all the money and they put it into the S&P 500. Others say, I want to come into this product and I want it to be a diversified portfolio like I'm used to. We can easily do that here as well.
Okay. Another question that's come up is in regards to the death benefit. And the first thing I think of with the death benefit is if you're purchasing this and you're using IRA money, your death benefit is going to be tied to the account owner. But what happens if you're purchasing it with non-qualified money and perhaps purchasing it jointly. Is that something that's recommended, or how would you deal with that?
Yeah, and I wouldn't think there's much of a difference whether it's qualified or non-qualified. The beauty of a death benefit is if the account value is down, if I have a death benefit in a typical annuity, right? I start with $100,000. If it's down to 80 and I have a death benefit, whether it's qualified or non, whoever that beneficiary is, the 80 would come back up to 100, and that's what you would get in this account. So the page that I'm looking at right now does not have a death benefit. All right, so basically what happens in this, let's say you buy this contract and 3 years in, you pass away. The nice thing about this contract is the beneficiary, whether it's a spouse or non-spouse, doesn't matter. The beneficiary has the ability to come in and just kind of step into this contract and take it to term. So let me give you an example. So let's say we start with $100,000 and the market doesn't do well, and you're down to 90,000, which, by the way, that's going to be the experience in this contract. If markets are up, you'll see your account value go up. If markets are down, you'll see your account value go down. So a lot of people do call and say, "Wait, I thought you said I wasn't going to lose money." No, your 100,000 could be at 90, and if it just stays at 90 to that 6 year, that's where you put the 10,000 back in the contract, and you're back up to 100. Right? But if we die while it's at 90, then our beneficiaries can come in, step into the contract, take it to the end of the term, and they end up having the exact same protection level that we did when we first started in the contract. So that's one option. One option is no death benefit. If I toggle down, this is one that has a more traditional death benefit. In fact, it says it right there. So guarantee of principal death benefit. So what that would mean, you can see there's no cost for the death benefit, but the caps are a little bit lower. And a lot of people, if you really like the 500 cap, I don't think there's a difference between 450 and 500.
I would agree.
One of them are not going to come close to that. So the death benefit would make sense. And here's how that would work. So let's do the same little scenario. You put 100 in, 3 years from now, it's at 90, and then we pass away. Now the beneficiary can immediately just get the $100,000 back. So that would be the difference in the 2 pages.
Okay. And one other aspect I actually want to point out is if you are using this product as what is known as non-qualified or funding it with after-tax money, the amounts that you would eventually get on the back end, as the money comes back out to you, the purchase deposit, whatever, $100,000, $1 million, comes back to you free of tax. However, any earnings above that are actually going to be taxed at an ordinary income tax rate. So while this can be used for situations where you are funding it with after-tax dollars, I would caution that when we're using these types of products in that manner, we're actually being even more strategic in how you would eventually get your money back, because we don't want you to be subjected to ordinary income tax rates.
Good point. And the full, just so we're clear, the full story is there's good and bad, right? You mentioned the bad. Ordinary income versus capital gains. Typically, ordinary income is going to be a higher tax.
Right.
In other investments, we have capital gains. And the other nice thing with other investments is when we die, that cost basis does what we call a step up. That doesn't happen here. But what does happen here is for the time period that you're not using the money, it's completely tax deferred, right? So this is one of those years if we're doing our taxes right now, there's a lot of people look at their investments, and obviously the investments went down and we still had to pay tax, which is never a pleasant thing. I had to do it. I mean,
not if you're a CORA client. We do our best to eliminate that.
Well, then that's where
we try hard.
That's where the upgrade is versus the rest of the world. So congratulations on that one. But this basically says, I like to say, it kind of takes it off your balance sheet, right? If you have $1 million and you put 200,000 in here, and we have really good years for the next 10, 12, 15 years, and we stay in this contract, we're not having current tax liabilities every year on that one. So that's the good news. The bad news is that the IRS says, well, we're going to let you grow tax deferred. At the end, you're going to have a tax story that's not as great, which is going to be that ordinary income.
Yeah, and I would add that we're certainly well versed on the tax aspects that are associated with these types of solutions, and there's actually some positives that can come from a non-qualified annuity if you're passing it along to whether it's a spouse or whether it's your children or grandchildren, in that you are still allowed to take the earnings of an annuity and stretch it over the lifetime of the beneficiary, something that has all but been eliminated in the IRA world with the passage of the Secure Act.
That's true. And
So,
one other thing we could throw in there is probably another event if I get invited back, but we could probably even talk about one of the patent stories that Lincoln has with a rider called I for Life, right?
Yep.
That has a tax advantage that a normal annuity does not have. But that would be, by the way, that would be available in this product as well. So I would, as you're sitting down with clients, you may want to stress that as well.
and last thing, there's no more outstanding questions, but I just wanted you to opine on this for 1 second. We actually have people joining us from a variety of states, as I like to think we are somewhat of a national firm now. So is there a state perhaps where this is not available, or are we good everywhere?
There's a couple. The wonderful state of New York, this would not be available. There's a couple out west that I never deal with. It might be like in Oregon, but pretty much up and down the East Coast, we're in really good shape, except for New York.
Okay, wonderful. If anyone has any additional questions, if they want to type them out real quick before we wrap up.
I apologize for the background. I think I now live in the windiest city maybe in this country. And it's not Chicago, it's Brigantine, New Jersey. And there's the ocean's a little angry today with that nor'easter that's coming up. So it's extremely windy. I hope you didn't have to hear that the whole time we were.
I guess I can attest to the severity of the winds in Brigantine, having experienced them many times, and it is in fact a Jeopardy question that it is considered the windiest city in the United States, and I can't even figure out how, but it is.
Yeah. After we're done here, I think I'll go pick up my trash cans.
Yep. If you could do me a favor, pick up mine too.
Yeah.
So I think there are no more questions, so we could probably wrap this up now. And I would like to let everyone know we have been recording this, so it will be available, and this will be the first in hopefully what are many chats like this on a monthly basis. Sam, I really cannot thank you enough for being our inaugural speaker. And, certainly at some point, we'd love to have you back to hear about some of the other wonderful opportunities that are available with Lincoln.
You're welcome. Again, honored to be the first. I appreciate it. Thank
you. And thank you to everyone who has joined us. And please, if you have any questions, you can email me, Sal, S-A-L, at coracap.com, or you can reach out to your personal advisor, and we're well-versed on this solution and can certainly help you out. And thank you very much, Sam.
Thank you.
Take care.
Bye.
Goodbye.